Welcome to TP Talks, PwC's Global Transfer Pricing podcast series, where we focus on key transfer pricing developments around the world. I'm David Ernick, a transfer pricing principal in PwC's U.S. Washington National Tax Services practice. Joining today's podcast is Osman Mollagee and Michael Butler. Both are PwC Transfer Pricing Partners based in South Africa with over 20 years of experience in transfer pricing. Michael and Osman are joining me today to discuss the current transfer pricing climate in Africa. Michael, let me turn to you first. So to give a little background for our listeners, I have limited knowledge about the business environment in Africa, to be honest. Can you give us a little bit of background about the environment there in terms of things like what are the established and emerging industries in the Africa region that have a need for transfer pricing?
Thank you, David. Africa is a large continent with a lot of different countries. So obviously, each country's got its own peculiarities, and it's hard to pick up trends that apply equally across the entire continent. But as a sort of bird's eye view on it, you will see that extractive industries such as mining, oil and gas, any of those sort of commodity type industries, Africa would be exporting that, less so on the beneficiation of the raw materials. Those raw materials then get exported, and very often finished goods would be imported. So if you look at Africa as a whole, between Africa and the rest of the world, there's a large outflow of those type of commodities, inflows of finished goods, pharma, capital for that matter, and various goods and services. Within Africa, there is also growing intra-African trade, and that's something the continent wants to promote and establish a free trade area within the continent. So the countries also levy transfer pricing within each other, between each other within the region. Other than that, really, it's not that different to everywhere else in the world.
Yeah, Michael, perhaps the point that I maybe add just in addition to what you've said is that I think it's useful to keep in mind that by and large, the majority of African territories are inbound capital importing territories, which means that there are lots of African-based subsidiaries of foreign multinationals. So that inbound dynamic and the expectation that there's an outflow of profits to the US-based or Europe-based parent is a particular focus area just because of the inbound bias in Africa.
Absolutely. And it leads to an interesting dichotomy between the continent wanting to attract investment from sort of first world capital rich countries, and then sort of saying, well, hang on, why are you pulling out all your profits from us as well? So it's, unfortunately, you can't have your cake and eat it. And that's what transfer pricing is trying to do, is making sure everything's fair on all parties concerned.
Thank you, Michael and Osman. That's very helpful in terms of the background for the economic environment in Africa, and especially the tensions you mentioned, Michael, given the large inbound presence and the typical tax policy issues that we could expect from that. Given that economic background, that the climate in Africa currently, Michael and Osman, what is the current tax and transfer pricing landscape in Africa currently? What are the most important issues and the sort of things that you both are giving advice to clients on? Let me turn to Osman this time first, please.
Thanks, David. So yes, I mean, I think one of the things that we always used to say in Africa as a general matter was that there's this kind of aggressive tax regime across the continent where there's this pressure on revenue collection, and that's definitely the case. But it's obviously interesting that these days that is not very different from most of the territories around the world. So that pressure that we see on revenue collectors, whether it's in the developed nations or in developing countries, it's no different in Africa. I do want to come back, though, to the point that Michael and I were making earlier on, is that given the fact that there's this strong inbound focus in Africa, the two areas that you will find revenue authorities focusing on the most are areas that focus on the cross-border extraction of profits. So we typically end up seeing a lot of activity in the area of withholding taxes, which I know is not part of our discussion today. And secondly, transfer pricing. So transfer pricing disputes are definitely, without a doubt, on the uptake. And in applying those rules, the kind of landscape as a general matter, and I really use that term general matter very broadly here, is that the OECD transfer pricing guidelines are generally understood, generally applied, and respected. However, we have this kind of cool, what I call cherry picking in many African territories, where actually some bits of the OECD guidelines don't work for us, or we'll reinterpret them and apply them a little bit differently. I think you'll find in South Africa probably a closer following of the OECD guidelines. And it's interesting what the specific topics might be. But let me stop there for now, David, because as you would have heard this, I can carry on this topic for a while.
Yeah, it's interesting if I can just chip in just on the landscape. Transfer pricing is definitely rapidly on the rise throughout the continent. So in the last couple of years, you've seen many of the countries bring in legislation to say you have to file a local file, whereas in the past that wasn't required or it was on a voluntary basis. Now you're seeing great many countries saying you've got to file it, and you've got to file it pretty quickly after year end in some cases. So it is, the pressure is on. Politically also, it's seen as a nice tax for politicians to promote because it's taxing the multinationals as opposed to the locals. The trend is for countries to say they follow OECD. So if I call up my colleagues in just about any country in English-speaking Africa, they'll say we follow OECD, but then the local revenues might have their own, I think Osman was alluding to that, their own slant on what does that mean? How do we interpret that? And usually that can be fairly pro their country, naturally. I mean, you'd expect that, but we've seen some of the countries be quite aggressive on that. So I would say that the local tweaks are more so than I would see in, say, Europe, for example.
Yeah, and David, if I can add on to what Michael was saying, and maybe just draw your attention, David, a little bit to some of the, let's call it hot topics or focus areas that we see kind of a bit of a trend across many African territories. I mean, the one thing is, as a general matter, I think whether they call them management services or corporate head office services, I come back to the point I mentioned earlier on about Africa being inbound and a lot of the subsidiaries of foreign parented groups being here. So that is a clear focus area that we see across Africa. And the other thing is, I always find it interesting. I almost think that when some of the revenue authorities in Africa look at multinationals, they probably think to themselves, I'm sure you're going to say you're a limited risk distributor. Everyone's a limited risk distributor. So, whether it's in retail or automotive or anything, I think that's almost become a little bit of a curse word, limited risk distributor. And maybe just one last point I will make is that, interestingly, in South Africa specifically, because we're kind of a mixture of outbound and inbound economy, you'll find that focus on corporate services, management services, it goes both ways, because obviously if you're the inbound country, you'll be suspicious that you're being charged too much, and if you're an outbound nation, then you're concerned that you are charging too little.
And just on that, there is, as with most countries, I suppose, a degree of skepticism when things come in through tax havens. I've seen a number of the countries, actually their revenues go so far as to say, we will not respect the DTA between our country and a particular tax haven, which is just completely illegal, and then it's got to go to court to get overturned. So there is a strong pushback in line with BEPS, but it's South Africa, certainly I haven't seen that, but the revenue does look at things very closely, and you must dot your I's and cross your T's. As an example, I've had one multinational where purportedly a whole lot of things happened in the tax haven. The revenue took a data dump of all the group's emails, trawled through thousands and tens of thousands of emails, found things whereby stuff was clearly done in country A instead of in country B, but the tax said it was done in country B, and revenue said, well, sorry, we are assessing you in country A. So they can get quite sophisticated and stand their ground, rightly so in many cases. So make sure you do things properly.
Thank you, Michael and Osman. Those are excellent comments, and I really find them fascinating for the reason that, as I said at the beginning of the podcast, I'm not really that familiar with the economic environment in Africa and the most relevant transfer pricing issues there. But a lot of the issues that you were mentioned, I really heard some common themes there, even among the developed and the OECD countries. And there does seem to be this tension across Africa that is common to pretty much every country about we want to have a business-friendly environment, we want to attract multinationals, we want to have a big inbound presence. But there's that tension with we also need to collect revenue. And in doing so, there's sometimes pressure on what the existing rules are and how they should be interpreted. And Osman, in particular, you mentioned the use of withholding taxes, and those are viewed favorably in Africa. And that's been a big tax policy issue for a long time, especially in the US. We've tried to eliminate or minimize withholding taxes as much as possible because those are seen as barriers to cross-border trade and investment. And yet they're very attractive from a tax administration perspective in certain cases because they're simple, they're easy to apply, and they collect revenue. And you can avoid a lot of the complicated transfer pricing issues with respect to applying the OECD transfer pricing guidelines and the arm's length principle. And then, Michael, also what you said about some of the countries, the tax authorities disregarding or recharacterizing the transactions. We've seen that over and over again from developing countries too. So it's very striking that there really are a lot of common themes in the issues you just mentioned there.
Absolutely, and on the withholding taxes, for the exact purpose, reasons that you've said, it's simple, it's easy to apply, it's just on gross. Particularly in the transfer pricing scenario, if you need to watch out, because if you're suffering a high withholding tax out of country A, and you've only got, say, a 5 or 10% markup in country B, who performing, say, the services, they're going to be underwater because the gross withholding tax really puts them at a loss. So you've got to take that into account and sort of think that through before you just blindly apply your TP formulas, because I don't really care what the theory says if of when you apply your markups before and after tax. If you're losing money, that can't be arm's length.
Yes, agree. And just one other point about one of the things you said too about that some of the countries in Africa, they say they apply the OECD transfer pricing guidelines, but they have their own special way of doing that or certain exceptions in certain cases to the arm's length principle and the transfer pricing guidelines. And again, we've seen that pretty much in every developed country too. We apply the arm's length principle, we follow the OECD transfer pricing guidelines, but for certain exceptional cases, we need to have special rules or certain exceptions to the arm's length principle, which in practice almost eviscerate the arm's length standard, the use of those special rules. And then that raises the question too of, well, what does it mean to apply the OECD transfer pricing guidelines in a world where now we've got the OECD through the Pillar 1 project, which we'll talk a little bit more about later in the podcast, essentially being one big special rule to apply for the transfer pricing guidelines, to apply formulary apportionment instead of the arm's length principle based in the guidelines in certain circumstances. So I guess another way of saying we've got the arm's length principle and the transfer pricing guidelines, but it does seem to be constantly evolving to adapt to current issues in the international tax environment. So that's all very helpful, Michael and Osman. Let me move on to the next question now. Let's get a little bit more into the controversy environment and thinking about some of the more aggressive tax authorities and with the expectation for increased audit activities across the region in Africa, what are some of the current audit processes and what avenues are available with respect to dispute resolution more generally? Michael, can you kick us off on that, please?
Sure. So if I take South Africa as an example, your revenue is quite aggressive, as you've said, as many countries. What happens is the revenue will have a look at the matter. They'll ask some questions. They'll then open up an audit. You then go through a process with revenue, and then they assess you. And you say, "Well, hang on, I don't like that assessment. I don't think it's right." You can then object to that, and then you've essentially got, broadly speaking, two avenues. You can, well, the one avenue in terms of the local law, you would either you go to court, which, to be honest, people don't want to do initially because it's expensive, and revenue up to now hasn't wanted to have too many transfer pricing cases because they're scared of the precedents. So they've been, although we've had transfer pricing in the book since probably about 1997, the approach has been from revenue that they rather try and settle and attack you one by one rather than have court cases which set a broad precedent. So you can either go to court, which people don't want to do, or you can enter into a negotiation with revenue, which isn't binding, but that's the route most people take. And then you both parties set out their technical standpoints. Is a bit of a horse trade, and you get to a position which everybody can live with. The alternative then, which has been happening the last few years, and it's happening increasingly, is going to map the mutually agreed procedure between the revenues. South Africa's been doing that. A couple of the countries in Africa have been doing that, but it's not broadly done. And that's, I think, partly because many of the countries don't have the expertise to do it, or you've got a small revenue authority, so you've only got a handful of people with transfer pricing in revenue experience. And they then have got to go up against the US or UK, which they see of having a battalion of lawyers on their side. And they don't want to get into that because they feel it's a bit difficult. So we are seeing MAP happening more and more, but it's not as broad as you would find it in more developed countries. And that's essentially what happens there. So usually negotiations doesn't often get to court. There have been some cases in South Africa, more on procedure matters. In Zambia, there have been some cases and elsewhere, but usually it doesn't get that far. But it's changing slowly.
The points we were making earlier on about there being a kind of spectrum of approaches to dispute resolution in relation to many transfer pricing aspects. Certainly in the case of controversy and dispute resolution, that is also the case. I mean, I think as a South African, we like to say that here we've got a relatively established tax administration law, the rules around, how long, does the revenue have when the SA Revenue Service, how long do they have to respond to you when when they write to you and you respond to them? And as a general matter, I suppose they stick to the rules, but as a general matter, that's relatively established. And I do think that's one of the reasons why there has not been a single transfer pricing court case in South Africa, as an example, because you get to a reasonable-ish conclusion through the dispute resolution negotiation process. In other parts of the continent, our experience has been we do have that kind of experience to some degree, but there's also the other extreme as well, where there's no tax administration framework or respect for taxpayers' rights, and it actually really becomes a matter of understanding who the individuals are that you're dealing with, also understanding that any sense of going to court in some countries might actually mean a sense of being unpatriotic if you find in favor of the taxpayer. So there is a bit of a spectrum across there, and I think multinationals will have different experiences in the different territories. But as a general matter, we stick to trying to demonstrate the emphasis on compliance.
Very good. Thank you both for those comments. So at this point, let me turn now to the OECD project on the digitalization of the economy, the ongoing project, and pillars 1 and 2, because obviously this is the most high profile issue in international tax currently. It's hard to have a podcast without having a little bit of a discussion on pillars 1 and 2. And in terms of the developing economies and the African countries, so the OECD has really gone out of its way to make sure that all countries have the opportunity to be represented and be part of the Pillar 1 and Pillar 2 work that's going on at the OECD through their use of what they refer to as the inclusive framework on BEPS. So really very much trying to give the developing countries a voice at the OECD, even if they're not full members of the OECD. And we're at a little bit of an inflection point in that project now on both pillars 1 and pillar 2. We've got to have a lot of consent from all countries across the world to finalize that project. And I wanted to ask you, Michael and Osman, about the perspective of the developing countries on pillars 1 and 2. And what do you think the countries in Africa and the tax authorities there are looking to get out of pillars 1 and 2? And I'll just note very briefly, one of the most recent developments, of course, we've seen from the UN, the United Nations, in recent weeks. They've announced their Global Tax Cooperation Framework project, where it seems that the UN will be looking to take a more active role in international tax issues. And I won't get too much into that because it's a very new development, and we could have a full day-long conference on what that potentially means, whether the developing countries that are part of the inclusive framework are looking to displace the OECD work or whether they view that as a supplement. But given that sort of very general background, Michael and Osman, what are the developing countries looking to get out of pillars 1 and 2? What are their sort of red lines that they'll need to view this project as a success? And Osman, could you start us off, please?
So, David, I suppose the bigger issue on the looking at headlines at present is probably pillar 2, but maybe let me talk about pillar 1 a little bit more first. So, but before I do that, David, let me just talk a little bit about the inclusive framework and make the point that actually the majority of African nations are not part of the inclusive framework. That doesn't necessarily mean that they've decided to exclude themselves from the process. So just coming back to some of the things that Michael and you were saying earlier on, one of the things that we do see is that there's a sharp focus on what is happening at the OECD level when it comes to pillar 1 and pillar 2. And we would actually see the informal adoption of some of those principles. When specifically on pillar 1 and specifically on amount A, there's definitely a sense of, I would say, almost disregard from Africa in generally, because if you look at the way the formulae stack up, they might go, or they have been saying, well, if amount A of pillar 1 ever became a reality, we would be competing for total sales volumes with the likes of Europe, the likes of Australia, the likes of the US, and we, it sounds like a cool principle technically, but we don't think we're going to get much out of it. And what has happened is that at the OECD level, we've always seen this amount A of pillar 1 as an alternative to something like digital services taxes and African nations. And again, just to repeat Michael's point from earlier on about withholding tax. So African nations have already started saying, actually, we like this digital services tax. Yes, let's just slap on another withholding tax. We don't think amount A is going to bring in that much revenue. And this is a quick and easy way. Again, David, you made the point earlier on about how quick and easy withholding tax is. I will say that most of Africa is probably waiting with bated breath for the conclusion of discussions on amount B of pillar 1 when we start talking about what exactly do you mean by a distributor and what is a marketing function, how are those defined, and how do you get some kind of guaranteed return on that. When it comes to pillar 2, and I'll talk about that very quickly, again, the point about monitoring what's happened. South Africa, as an example, has signed up, and we've basically said, look, if pillar 2 discussions, if they go ahead and it's successful, we are probably signing up. The rest of Africa, not so much, but they do like the ideas coming out of pillar 2, even if we don't necessarily sign up. So in pillar 2, when we have all these varying levels of potential taxation, especially at the local country levels, those things, in my view, are being very, very closely monitored in Africa. And I think we can expect a lot of those things to be adopted, not necessarily by signing up to some kind of multilateral instrument,
So, Osman, let me have my 2 cents worth. I think in chatting to some of the revenue officials in some of the smaller African countries and people who may assist them, etc. Yes, they, in theory, have sort of some sort of voice, even by proxy. But the reality is, I think that a lot of the discussions are driven by the big boys at the table, and I think there's a little bit of fatigue, because you've got to remember that many of the smaller African countries have limited depth of number of people with skills in these sort of highly technical areas. Now they've got to send those people to keep up with the all the OECD developments, and things keep changing. And I get the impression some of them are saying, well, you know what, let's just wait and see what happens in the end, and then we'll decide, as opposed to trying to be very involved with a rather dynamic and difficult process, where they might feel that they don't add that much, they don't get taken that seriously anyway. And it's going to vary from country to country. But certainly that view I have heard expressed.
Okay, so Michael and Osman, that's all very helpful. And as we come to the end of our podcast, I always want to focus on some sort of forward-looking issues that we can think about for our listeners. So given the environment in Africa and this sort of tax policy issues that you mentioned, and considering how the economy there will be growing and developing in future years, what sort of things can we expect going forward in terms of, say, the evolution of the tax environment in African countries, especially with respect to transfer pricing issues? What sort of things should taxpayers there be looking out for, especially with the idea of we'd like to be able to do business in a friendly environment, and we'd like to have certainty with respect to the tax rules as much as possible?
So the certainty is absolutely crucial. That's what everybody wants in business. It's probably more important than the headline tax rate. I think Africa, in general, we're seeing we've got a young population as a continent, so it is growing. So you've got that population dividend, as it's sometimes referred to. So I think there's going to be growth in the economies, not as much as was hoped for maybe 15 years ago, but it's picking up again. And as you get more political stability, even more so. On the transfer pricing front, I think what you're going to see is more sophistication, so convergence between the type of approach that you get in Europe or the US or UK. Africa is getting more and more on that bandwagon. The things that I would watch out for is anything where foreign exchange has a impact, because the currencies are very volatile, and it doesn't take too much of a currency swing if you're targeting a 5% return or even less, depending on your model, for that to go underwater or shoot the lights out. So watch out for currencies, the impact on that. Debt, we're seeing a lot of movement on that in the continent. Many countries do have local debt rules, but they want to bring in the OECD general stuff as well, some of them. Certainly in South Africa, that's a big deal at the moment. And we are seeing, just with the general growth in trade, you're seeing more and more transactions. So you're seeing the same as everywhere else. When I went to the conference in Germany recently, the PwC Worldwide TP Conference, the stuff we are talking about at home is the same as everyone in Europe is talking about. So by and large, local nuances and revenues takes on it, but the broad same themes.
Michael, from my side, and David, I think I'm probably going to be repeating a little bit of what Michael said. So, but just a couple of points. The first one is probably to keep in mind that transfer pricing is continuing to grow as a target area for many revenue authorities. I mean, many territories in Africa don't have transfer pricing rules yet. And I mean, a new country is being added on a regular basis. So there's an increase in awareness and sophistication is my first point. The second point is I think we can expect a little bit of familiarity, and this is definitely repeating one of Michael's points, that for multinationals coming into Africa, you can expect that there's this familiarity of, what is the arm's length principle? How does a local file look like, etc. That is definitely the way that we are moving. And my last point, though, is also a little bit of a warning, though, is we know that for most multinationals, from an efficiency and costs perspective, it does make sense to kind of have a template style local file that you use for all of your affiliates and subsidiaries around the world. But I will make the point that we will need to find, or we do already need to find, the right balance between having something generic that applies to the group as a whole and having something that is in-country tailored, because that is probably where we see the biggest areas of attack, where you have an in-country subsidiary and its local file of its approach to pricing or profitability is simply this cookie cutter approach of the way it's done around the world. Most African revenue authorities expect to be treated a little bit more special. Thanks, David.
Excellent comments. And as we close today's podcast, I want to thank you, Osman and Michael, for joining me today and for that very insightful discussion. And I also want to thank our listeners for joining again, and to let you know that we will be back next month with our next episode. But until then, thanks for listening and have a great day.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.